1930s during the Great Depression from the federal government. They were thrilled to be able to get out and loan again with the guarantee that if the loan went south, they would get back a good portion of their capital. But what happened after World War II is almost every single year there was a proposal in Congress to liberalize the terms. Let's extend it to, let's go from 15 years to 20 years to, we all know, we're very familiar now with the 30-year mortgage. That was unheard of back then. Let's have less and less down payment. Let's have less and less interest. Well, it's a great deal for the consumer, but this is a problem for banks to put these very long-term, non-liquid mortgages on their books. And so what I found is there's this interesting game going on between private actors and the government, where the banks are trying to defeat these liberalizations, but one way they're trying to defeat it is by lending more and saying, see, showing up as if it's a progress report to the committee hearing, saying, see, we're doing a good job, we're reaching more people, and please don't liberalize these through legislation. And one thing I thought was interesting in the book, too, is you mentioned this, too, with the lending to foreign governments, particularly lesser developed countries. And that really got me thinking I really need to go, and I had thought this before, is go research that piece too, because that's a foreign policy story. And so is spreading home ownership. We need to look better than the Soviet Union. It's the Cold War. So you have that really interesting piece of where the United States we need to be seen. I'm sure this is, their calculations with the Soviets, but also thinking too about what the government is pushing with consumer credit, lending. I've started looking a little bit into the student loan piece. That's perhaps another bubble that may be bursting at some point. So I found that there, and I also want to say that I urge you to purchase the book. There's a lot of good information in there, but they do a great job of telling the story, and that's what I was very impressed with that.
Thanks. If I could just add on that, it is really striking the way you saw what in the 1920s, essentially, Citi looked at the American saver and said, well, they bought war bonds. Maybe they would be interested in buying all kinds of bonds, maybe stocks. But this drive to to democratize credit and banking and other financial services was built on the idea that there was a market there that other people weren't capturing, and we can. And you're right, you look at recent decades, so much of the drives into particular markets are about political motivation and encouragement, whether it's obviously lots of federal activity to drive people into the mortgage market before the last crisis, but also in the 1970s, this was a big part of Citi's lobbying strategy. We go through that in the book, where they wanted to run with very little leverage, and they wanted they were getting a lot of credit from politicians for pushing banks to or pushing loans to less developed countries. It was seen as a very positive thing for the world, for American foreign policy, for just about everything, really, until those loans started to go south.
So they were like the countrywide of the third world.
Yeah, you might say that.
Gary, you of course wrote a book about Too Big to Fail, right at the time when it should have been most useful to make some timely changes in the financial system. But alas, I don't think all of your advice was taken, and in any event, we had some more big bank failures. You wrote there emphasizing the role of moral hazard and the dangers of bailouts, and predicting that the regulations in place before the crisis, particularly the Federal Deposit Insurance Corporation Improvement Act, wouldn't prevent more too big to fail bailouts. So to what extent do you think the Citi episode during that crisis illustrates the predictions or bears out the predictions you made in the book? And to what extent do you think it was, in fact, a very unique case?
No, I don't. I actually don't think there was much unique about it, with perhaps the exception of the magnitudes involved. But other than that, I think it was predictable given the incentives in place, given the precedents in place. That's not to say, I could quote you chapter and verse on the virtues of our book, but our book did not try to identify the institutions most likely to fail in the next round, nor did we try to predict exactly when it might happen, basically because we had no idea. But I think we did have some insights that were valuable and unfortunately were generally ignored. And that had to do with the incentives that were in place, some of which have already been discussed, which led to mispricing of risk. Risk was priced too low. You know, bankers like the rest of us respond to what they observe in the marketplace. They respond to prices, they respond to incentives. It's not that they want to run the bank into the ground, but on the other hand, if they see something that looks like it's priced to be a good deal, they're going to try to take advantage of it. And that was part of the setup, part of the problem. And it's why, by the way, Citi's history was maybe particularly fraught. And I too enjoyed the book and learned a number of interesting things from it. But you know, if we look back at the crisis, it was not exclusively a Citibank. If it had been, it probably would have been a much less challenging crisis. So what we observed, I think, was problems that pervaded a good chunk of the financial system that were identifiable in advance, that in my judgment could have been at least partially addressed in advance, which would have hopefully led to a less severe crisis from a number of metrics. But you know, we can't rewrite history. We don't have the counterfactual. We are where we are.
Now, could you tell us a little bit about Fiducia and what it tried to do and why you felt that wasn't adequate even at the time to rein in too big to fail?
Well, Fiducia, I think the principal part, or one of the principal parts in Fiducia aimed at dealing with too big to fail was prompt corrective action, which basically talked about regulatory intervention while financial institutions still had positive capital, positive net worth. A big flaw in that was it wasn't market value, it wasn't based on market value accounting, it was based on book value or historic accounting. You kind of know in the financial world when you see that problems are looming. Now, you know, a lot of people recoil when I talk about mark-to-market accounting for banks. But as we say in Minnesota, it takes a model to beat a model. So which means if you don't like mark-to-market accounting, what do you like? And you know, whatever you might say about mark-to-market accounting, which in our proposal at the end of the day was part of it, you know, you've got to mark assets to market. And yes, banks have some fairly opaque, obscure assets on the books. But we live in an age where information is much less expensive to gather and analyze than it was 20, 30, 40, 50 years ago. I don't find it a credible excuse to simply say, well, we can't value these things in any contemporaneous way. I mean, that just can't possibly be true. Can you value them accurately down to the last dollar? Probably not, but you don't need that level of precision.
My follow-up question is really for Gary, but also for the other panelists. So since the crisis, of course, we've had another round of reforms. We've had Dodd-Frank and all that it involves. So does that do much in the way of preventing or reducing the likelihood of Citi or any other big bank being rescued in the future?
Well, I'll lead off, but I'll try to be concise. I'm actually cautiously optimistic about the implications of Dodd-Frank, and in particular about the Recovery and Resolution Plan or living will mandate in Dodd-Frank. And there are several reasons for that. First of all, Dodd-Frank does mandate, and major financial institutions have now produced living wills, that is, how they can be wound down, say, over a weekend, without imposing undue costs on other financial institutions, the financial marketplaces more broadly, or the economy. The first round of these things weren't rubber stamped. I can't testify to the quality per se, but regulators rejected early submissions. So everybody, as far as I can tell, is taking it seriously. It's part of the law. It's mandated in Dodd-Frank, and regulators have to sign off on them. And while this isn't the only thing that should be done and must be done, it's an important first step because it's preparation for dealing with the next problem or series of problems at large, complex financial institutions. So I think there's reason for guarded optimism that we are in a better position to deal with at least those kinds of institutions at the next point where financial difficulties have arisen, and that's very critical. It's not the end of the story for a number of reasons. I won't dwell on all of it, but I will say, there are a couple things. One is the quality of the plans themselves, the understanding of uninsured creditors, that they could well lose money. I think a lot more communication should be done about the nature of the change in the regime so that uninsured creditors understand that whatever they make of the past, the position going forward is different. And policymakers at the end of the day will have to have confidence in these plans that they can be implemented without imposing the undue costs I alluded to.
Fellows, what do you have to say based on your reading of the history of Citi? Could this be a device to make it less likely to get bailed out next time it screws up?
I think the resolution plans are a good step, but we have absolutely no idea how that's going to work in practice. They haven't been tested. These plans, from what I've heard, can be thousands of pages long, with dealing with hundreds or thousands of subsidiaries, and it's just going to be interesting when that program is put in place in an actual crisis. As far as the legal infrastructure and Dodd-Frank, I mean, I'm just very skeptical. What happens almost every crisis is the rule book gets thrown out to a large extent, and you have new legislation. In the last crisis, you had TARP, you had HERA. TARP was mostly used to prop up the big banks, and HERA was to prop up Fannie and Freddie, and they're still lingering in conservatorship now. And you've had that in the past. In the 30s, you had the Reconstruction Finance Corporation, new law in the middle of a crisis. So I think whatever the legislative framework is right now, I wouldn't say is completely irrelevant, but because when a crisis comes, you'll probably have legislative change, it's certainly not set in stone.
May I add a little something to
Yes,
that?
please.
Because it makes me think, you have this image, we're talking about institutions and banks and bailouts, but I don't want to lose sight of the little guy, right? The consumer, and there's a lot about consumer protection in the Dodd-Frank Act. And I'm thinking about a documentary that was made in 1970 called Banks and the Poor, and there's this image of a woman crying because her house is being repossessed by the bank over not a lot of money that's owed. And you have that image, okay, markets, this is where all, and you're thinking of Walter Wriston, this very well-known, respected, famous banker, head of Citibank, doesn't retire until the 80s. He's a huge proponent of free enterprise. You know, he loves to talk about it, write about it, very vocal about it. And you have this image, but then you see the woman's house getting taken away, but yet that